There are things that you need to check before entering into every trade. Having a checklist before every trading session will dramatically improve your trading performance. My name is Lucas, this is Magic Markets, and today I will show you what you need to check before entering into every trade. So the first thing that you always need to check before entering into every trade is market structure. Before entering into buy or sell positions, you always need to figure out whether the market is bullish, bearish, or side moving. Now, in order to do that, it is pretty simple. First of all, you look at the general market trend. So over here, if we look at this particular example, we can see that the market is climbing upwards and the general direction is basically moving up. And then if we look at the lows of the price right here, and here, we can see that all of these lows are climbing higher and higher, and that means that we are in an uptrend. Now, when you figured out that the market is in an uptrend, you are never interested in selling. If you start opening sell positions when the market is bullish, something like this awaits you. Basically, the price will usually hit your stop loss. Now, why that happens? Now, imagine again, we have an uptrend that you identify, we have higher lows and higher highs, the market is moving upwards, so it is really stupid and a very dumb mistake to go against the major market trend, and in this case sell, because look at this. For example, you opened your position right here and everything was okay, the market was moving your take profit, but then boom, it suddenly shifted and hit your stop loss, and that happened because you sold but the market was moving upwards. And that means that when the market is moving upwards and you are selling, you are always playing a very risky game, and usually the price will keep on climbing up and it will just hit your stop loss. Now imagine that you are at this market situation right here. So first of all, look at the general direction. We obviously see that the market is going from top to bottom of the screen. So basically the price is dropping. So we assume that it is a downtrend. Then to make sure, we look at the highs and the lows of the price. As you can see, this high is lower than this high. This high is lower than this high, and these highs are going even lower, and same with lows. The lows of the price are going lower and lower, so the price is dropping, and now we certainly know that we have a downtrend. Now imagine that you are in this situation right here. You marked your trend line, you can see that the market is climbing upwards, then you look at the trend, you think that now the trend will definitely shift, and here for example you have some sort of level, and look, the price broke the level, made a retest, and now it will surely go up. So you open your buy position, and guess what happens? Boom! Doesn't matter how big is your stop loss, it almost always get stopped out. And again, that simply happens because you are going against the market structure. The market structure is moving downwards, and look what you are doing. You are buying, and this situation right here, so obviously the price will go in your profit for a little bit, but then the inevitable happens, and boom, the price goes straight into your stop loss and you will lose money again. Now, the first thing that you check is market structure. Now you know why. And the other thing that you always must check is your entry point. Now, there are many different things on what you need to know in order to find a perfect entry point. Entry points are hard to find, trust me on that, but what you can do is minimize your potential to get stopped out, maximize your probability of your trade succeeding by doing a very simple thing like this. Now, a gray area is basically when you have your support and resistance levels, or you have your trend line, you never entry when the price is somewhere in the middle. So if you have a support level, here is where you should look for an entry, and this is where your entry point should be. So if you're interested in buying, you are being patient, you are not buying somewhere over here and then getting stopped out because you put too tight stop loss, and then boom, before the big move you get stopped out. No, When you are interested, for example, in buying, you wait when the price is at the perfect entry point, for example here, and then when the price is at support level, you open a position. And then you also leave some breathing room for the price, and then it is a whole different ball game, because probabilities will be on your side because you're not opening random entries into the gray area. Or if you have a different kind of strategy, you are always checking when the price will break resistance. So that means, again, you are never buying somewhere in the gray area, but rather when the price actually breaks your resistance that you are interested in, you then open a buy position, and boom, it is much better, and here you could have potentially made money. Now again, we have a very primitive, very simple example, but this really illustrates everything well. So again, imagine you have a downtrend over here, you have drawn your trend line, you have these two touches right here, and you know that this is a downtrend, you are interested in selling. For example, you did your analysis and maybe you have drawn some sort of a level over here, and then you are interested in selling. So the first thing, again, that you need to know when you are finding an order point, you cannot sell into the gray area, and gray area is somewhere over here between levels or between trend lines. So if you are interested in opening a sell position in this situation, you always need to check for the best entry point, and in this case the best entry point would be at the trend line or just below your support or resistance or whatever you're doing level. And this is why if you would be opening positions right here in the gray area, most likely you are not doing big stop loss because you want to have a great risk management, and then boom, you will get stopped out. But rather, if you use an entry point as this trend line right here, boom, then your chances of succeeding is much higher. Or in other case, if you're using this resistance level, boom, the price came here to retest, you open a sell position, and then you leave some breathing room for the price, and you will be very unlikely to get stopped out. So this is really important thing that you need to check before every trade. First of all, you check the market structure and you figure out whether you're even trading in the right on the right side. And then the second thing that you need to check is whether you're entering from the right position and your timing is on point. So these are important technical analysis things that you need to check before entering into every trade. But remember that technical analysis is not the only thing that you need to check. Now, another important thing that you need to check before entering into your trades is market sentiment. Currently, I'm on the DailyFX platform using the market sentiment, but you can find it on any other website or platform. Basically, market sentiment is nothing more than just the amount of traders that are longing the markets and the amount of traders that are shorting the market. And this can provide you with a lot of great insights of what you can do on your pair. Now imagine that you select this pair right here, euro against the British pound, and we can see here that 65% are bullish on the pair and 35% of traders are shorting the market. Now what information does this give you is that you should always go against the market sentiment. So if you're, for example, if you are trading this pair right here and you are interested in selling, then you would be right, because the majority of traders are buying and the majority of traders are usually wrong in trading. So that means that you should be interested in selling. And if the signal is, for example, bearish, because a lot of traders are selling, the majority are selling, that means that you should be interested in buying, because the market is likely to do opposite of that, because we know the majority of traders actually lose money. So market sentiment is a great tool. Do not use it alone. It's only a complementary tool, complementary check that you can do before entering into the trade. It will provide you with more information. You will know what other traders are doing in the market. So great thing to know this market sentiment, but never use it alone to make your decisions. Thank you guys for tuning in. Hope you guys enjoyed this episode. If you are enjoying this episode, leave the like button, subscribe. I do a lot of these in the channel. If you're interested, you can watch my other videos concerning supply and demand or beginners day trading strategy, which is really useful if you're just starting out. So hopefully you guys enjoyed it, and see you in the next one.